Dear student, I hope you have seen the study material what I have sent to you all through the Google class. You saw the lecture of S.K. Agrawal over the different concepts of national income and its related aggregates like final goods, intermediate goods, consumption goods, producer goods, gross investment, net investment, consumption of fixed capital, and so on. Today we will see the two things, and after that we will see how to calculate national income through the net value added method. First of all, I want to share you about the economic territory of a country, which is also called domestic boundary of a country. It is little bit or different from the concept of political boundary of a country. Economic territories, that is domestic boundary of a country, also it includes such geographical area which is administered by the government. In a simple sentence, we can say the domestic boundary is a geographical area where the rule of our country applied. It may be in our political boundary, what you are earlier seeing, which we can say our political map of India, as well as it may be somewhere else across the world, right? For example, the political boundary of our country, which is administered by the government of India, as well as the water boundary of a country, which is 20 nautical miles from our coastal area, as well as the sea vessels, our Indian embassies and consulates locating in different part of the world, that also included in our domestic boundary, as well as any economic activities held by India in the international bodies, means the area which is governed by United Nations organization, that also come in our domestic boundary. For example, the economic activities which are held in the consulates or in the Indian embassies locating in America, it is also, though it is located in America, but it is also treated as a domestic boundary of India, and it will be included in the economic territory of India, not in America. Same thing what held in our country, that also to other countries. Okay, now other things, the normal residents of a country. Normal residents of a country means a person or a firm which residing in our country more than 1 year and their center of economic interest lies in our country. They can be treated as a normal residents of India. It means central of economic interest means where the people are dispersing their earned income, that we can say that is the normal residence of a country, and all the income generated by normal residents of a country during the year is called national income of our country. Okay, so this is the simple concepts of national income. We can define national income is the income generated by normal residents of a country during financial year. Okay, in previous classes like in class 9 you have read the factor of production. There are four factors of production: land, labor, capital and entrepreneur. Right? These are the four factors of production: land, labor, capital and entrepreneur. These are the factor of production and they generate income because they render the productive services. For the land, it is treated as rent. The remuneration of land is treated as rent and royalty. Rent and royalty. For labor, it is remunerated by wages and salary. It means labor got return against their productive services. What they do, they get wages and salary in cash and kind. It is also known as compensation of employee. Okay. Next, capital. It can be machinery. It can be, we can say simple word, investment. Against investment, the investors receive interest. It means the remuneration of capital is interest. Same like organization, we can say entrepreneurship, who organize land, labor, capital for production of any final goods and services. For that, their remuneration, they are taking risk of business and their remuneration is called profit. Right? It is known as a firm's earning, we can say, or entrepreneur earning. Right? Profit, interest, profit and rent and royalty are treated as operating surplus. Right? And wages and salary in cash and kind is treated as compensation of employees. That include wages and salary paid in cash plus contribution of employers to the social security. Be careful, the contribution of employers only, not by the employee. Right? the employer's contribution to the social security is given to the employees, and that is also part of compensation of employee. Okay. Profit later on also segregate in three parts. Profit is subdivided. On profit, government imposed tax, that is known as a corporation tax or profit tax, we can say, right? That means profit is subdivided in the three parts. Number one, the tax on profit. It means from profit tax will gone, that is known as a corporation tax. Plus, a company or entrepreneur keep some part of profit for the foreseen businesses as well as for the emergency investment as well as repairment or compensate the depreciation. Okay, that is known as a retained earning. Retained earning, or we can say undivided, undistributed profit. Rest profit is also shared by the investors, the shareholders. Some part of the profit is divided among the shareholders of a firms in the name of dividend. Right? It means if profit is not given, then we can add all these three things and we can get profit. For example, by adding corporation tax, by adding undistributed profit, and last, dividend. If we add all three things, then we will get profit. Okay? Right now. This is the remuneration of different factors of productions. And there is also some factors. Suppose our Indian factors are doing in America, doing productive activities in America, but their center of economic interest in India, and they send back all their earnings in our country, right? And from others country also. That is treated as the factor income received by a country, the factor income received by a country from across the world. It is treated as factor income earned from rest of the world, that is known as a factor income from abroad. In short form, it is known as a FIFA, capital FIFA, FIFA, factor income from abroad. It means what our Indian factors rendering productive services in abroad, they earn there and send back it to our country. That is our income, our factor income. That is why it is included in our national income. Second part, the similarly others country factors also rendering productive services in our country, in our domestic boundary. It means in our domestic boundary also some other countries factors rendering productive services, they earn in our country and send back their income to their respective countries where their center of economic interest lies. Okay, and that is treated as a FITA, FITA, factor income to abroad. It means this is the factor income which is generated in our boundary, but it will not mine, it will not ours. It means it will go from our domestic boundary to others country from where they belongs. Okay, it means it is not our income, though it is generated in our domestic boundary, but it is not by our factor of production. That is why the new concept come, that is known as a net factor income. Net factor income from rest of the world. Net factor income from rest of the world. Net factor income from rest of the world. It is treated as NFIA. It is treated as NFIA, net factor income from abroad. It is the difference of FIFA minus theta. It means it is the difference of factor income from abroad and factor income to abroad. And NFIA is our actual income which is earned by a normal residents of a country, suppose of India, in rest of the world. It will be included in our national income. Its value may be negative, may be positive respectively, but NFIA will be added in national income. Right now, so this is the NFIA concept. Okay, in the income method what we earlier shared through the text materials, in the income method the national income is a sum of compensation of employee, whatever the parts of compensation of employee, that will be treated as COE, compensation of employee, plus operating surplus, that is rent, royalty, interest and profit. If profit is not given, then you add corporation tax, we can say profit tax, retained earning and dividend. And if profit is already given, then there is no need to add corporation tax, undistributed profit and dividend again. It will lead double counting. Okay, because it is already included in profit. If profit is given, then no need to add all three things. This will be not touched. Okay, if profit is given, and if profit is not given, then we will add all three: corporation tax, retained earning and dividend, and find the profit. One remaining factor is there. The concept come about self-employment. Okay, many businesses are run self-rendered businesses where investor is the same, as well as he himself or she herself doing their works in their shops, in their factories. They invest their own savings, they operate their business in their own buildings, like that. Then we cannot separate their earning in rent, wages, interest and profit. It is not possible. So that such type of self-employed earnings are treated as income from self-employment. This is known as a mixed income also. Right? So in income method, if we add compensation of employee, National income will be through the income method, compensation of employee plus operating surplus, that is rent and royalty plus interest plus profit, and add mixed income, that is income from self-employment. This will be called domestic income. It means income in our domestic boundary, and its basic concept, that is called domestic income, is NDP of C. NDPFC, right? NDPFC, net domestic product at factor cost, that is domestic income. When we add through the income method compensation of employee, operating surplus, income from self-employment, we will get the NDPFC. And if we add NFIA, what you derived, NFIA in domestic income, we will get our national income. It means through the income method, national income will be equal to compensation of employees, rent and royalty plus interest plus profit plus income from self-employment and plus NFI, right? We will derive national income, that is called NNNPFC, net national product at factor cost. Okay, the difference of the value from factor cost and market price is the NIT. NIT means net indirect taxes. NIT is equal to indirect tax minus subsidy. If we subtract subsidy from indirect taxes, we will get NIT. And if we add any concept's value that is given in factor cost, and we need to convert the value from factor cost to market price, then we will add NIT in the value, right? Suppose in the national income, that is NNPFC, if we add NIT in NNPFC, then we will get NNPMP, net national product at market price, when we add NIT in national income. Okay, right? Now we come over the net value added method. Net value added method, right? Net value added means the actually at every production level how much value is being added in the goods. For example, a farmer produce wheat value of 1000. Farmer produce wheat of 1000. He sell it to the flour mill worth 1000. Flour mill convert the wheat on flour and sell it worth 1200. It means at flour mill level the value will added up to 200 plus 200. Suppose flour mill sell this product to the bakery and bakery make the bread. This is the third level. Bakery make bread from the flour and sell it in 1500. It means bakery add the value of 300. Finally, at 3 production level, farmer ate the production of 1000. Flour mill ate the value of 200 and bakery ate the value of 300. And the net value added will be equal to farmer's value addition as well as flour mill value addition and bakery value addition, and that will be equal to 1000, that is the share of farmer, and value addition of flour mill, that is 200, and finally the bakery value addition, that is worth 300, and the total net value addition will be called 1000, 200, 300 will be equal to 1500. This is called the net value added in the production. Okay, there is a concept gross value added, gross value added, gross value added, right? Gross value added and net value added. There is a difference of gross and net. Suppose we first see only the net value added at factor cost or market price. So first we see, because all the value, all the production is measured on the market price, so we will go through the market price. It means NVA MP. We add the formula NVA MP. This is nothing else than net domestic product at market price, that is known as a NDP MP. Right? NVA MP, that is equal to NDP MP, net domestic product at market price. It is also called in the value added method NVA MP, net value added at market price. This is equal to value of output, value of all the final goods and services, minus intermediate consumption, right? Intermediate consumption. It means for the production, whatever the raw material or other inventory items are consumed, that is treated as the intermediate consumption. If intermediate is consumption, then raw material and inventory items is included. No need to once again add raw material and expenditure on inventory items, etc. It will lead double counting. So we will treat only the intermediate purchases or intermediate consumption. It means from the value added, from the value of output, we subtract, yani we minus the intermediate consumption, right? We will get gross net value added, and minus depreciation, consumption of fixed capital, that is known as a depreciation, DEP. Okay, here the value of output is somewhere given clearly or somewhere we have to find out, right? So value of output is equal to, value of output means whatever the final goods and services are produced, their price, right? Then whatever is being produced, that will be either sold or remaining in stock. It means the value of output is not given if clearly, then we will find out the value of output through the total sale of final goods and services. जो सेल हो गया वो हो गया, परंतु जरूरी नहीं कि जो whatever the produce, whatever forms produced, all production will be sold. Some may be remaining with the forms. Then to find out the value of output, we take the total sale of output plus change in stock. Change in stock means closing balance minus opening balance. It means closing stock minus opening stock, that is treated as a change in stock. If we add the total sale and change in stock, this will be equal to the value of output. Is it okay? Right? So if value of output written, no need to worry. If value of output is not given, then from total sale and addition of change in stock, we will get total value of output, and from that we minus the intermediate purchases and depreciation, that is consumption of fixed capital also, and we will get NVA MP. Okay, NVA MP, right? Then income always calculated on factor cost. It means we have to convert it on the factor cost. To get NVA FC from NVA MP, if we subtract NIT from NVA MP, we will get NVA FC, that is NDP FC. So NVA FC will be equal to NVA MP minus NIT, that is indirect tax minus subsidy. It means from NVA MP, if we subtract the difference of indirect tax and subsidy, we will get the NVA FC, that is also NDP FC, and it is also known as a domestic income. If we add in NVA FC NFIA, that will be equal to national income. Okay, be careful, stay at home, and after looking this video, watch carefully and point out your doubts. After that, I will give some numerical questions and we will discuss your problem also. Okay, thank you, and stay at home and do self-study. Thank you.